Have you ever met someone that's really good at something? Not just marginally good, but better at something than anybody else you know. Well, maybe that someone is you. Now, being exceptional at something is a gift and usually a product of hard work. And kudos to those people that attempt to capitalize on their skill. Talent wasted, it's a shame. And for many reasons, most people never live up to their potential. And that reminds me of trade management. People will be in a solid trade, racing in their favor. However, at the end of it, they only receive a small market slice. Now, while you can't expect to pick off the entire move with any consistency, you probably could pick up more than you normally do. Now, many traders will tell you it's the 2 or 3 big trades that really make their entire year. Yes, they have many small wins and probably many small losses, but those longer-term moves with an accommodating market really stock their accounts. Getting in at a time when the move in your market is about to get underway and staying there, it's really a sad thing to waste. Just like people that have potential and they never chase it. Wasting the potential of a market that's getting underway is something that you don't want to do. The set and forget trading method is a huge selling feature. You place your entry, you place your stop and targets and just let the market play out. The biggest issue with that type of method is that it's missing one huge factor: trade management. How you manage the trade can greatly affect your profit and your loss. Think of trade management as a hands-on activity. When being hands-on, you are constantly aware of the strength or weakness of the market in relation to your position. When signs of market strength are present, perhaps you tighten stops with more give to them, and depending on your plan, you add another position to the trade. When weakness develops, perhaps you lighten the load or you simply exit and keep the majority of the profits that you made. I've seen many people give back a huge percentage of their profits hoping for the bounce that never comes once the market starts to correct. Day traders must be even more vigilant. Weakness can occur quickly on the short time frames, and your profitable positions can quickly flame out. You must have the ability to exit quickly, especially if you determine your trade entry was right according to your trade plan, but doesn't fit in with the current market context. That's a well-known fact that the majority of traders, they let the losers run and they cut their profits quick. And I get where that comes from, the fear of loss. However, that's the wrong way to continue trading career. I like to think that when weakness is present, I'm no longer welcome in the market. I'll take steps to lessen the damage and take the bulk of the trade in profit. If you firmly believe that 2 to 3 trades a year can make your year, does it make sense to cut your trades off at the knees? No, of course not. Expect the worst, but ride the best. You know what many traders do in a losing trade? They'll talk themselves to stay in the trade because they spot divergence. They spot a MACD crossover in their favor. They spot an upsloping trend line that price is falling to. They ignore the change in a trending structure that the market's making. They ignore the bearish engulfing candle that's wiping out a few days of upside gains. Let's imagine that you found a market where a trading range was broken to the upside, but the true move was being set up for the downside. You trade the breakdown of a bearish pullback at the dashed green line, and the market rockets to the downside. Price shows you the strong push down, and the drastic drop of the MACD indicator confirms that this move was far stronger than the previous moves. A price bottoms at the yellow arrow after a consolidation break, and you can see by the lower shadows that buying was being supported at this price. You combine your trading knowledge to allow you to decide your next move. Strong pushes in one direction can often be countered by a short-term climax. The MACD is starting to slope upwards. The bottoming candles are showing buying support. After seeing this small red candle which fails to close near the lows, you exit. You manage your trade using what the market was telling you, and you also know that while you're taking profits, other traders are still trying to short this market. Indicators are great for confirmation of your overall sense of the market. They also can come in handy when looking at the lack of momentum in a market. You can see price making a much different structure when losing its push than it does when all signs point to go. Now, on the same lines as trade management is how you manage your stops. Stop placement runs the gamut from a fixed percentage base stop to use of technical indicators. Basing stops on a max percentage loss you're prepared to lose has some merit, but it is really not based on the current market conditions. For example, using a money stop that comes from a percentage of your account can place your stop right in the middle of a zone that does not invalidate your trade. When placing technical stops, you're letting the market, when it breaks a condition that showed the trade was in your favor, to show you the door on the trade. It's the area that invalidates your premise for the trade. The issue that comes up with these is that traders fail to recognize it as a stop zone. Now, swing levels are prime territory for stop placement. It's also prime territory for the big money traders to run those areas to get better fills on their own positions. If using a technical level, you may want to allow for a run of that area and widen the stop from that zone. The main reason traders like to use the top or bottom of a pivot or a range for their stop is that it allows them to load up the position size. Understand that a simple break of those areas does not always mean your trade's invalid. It's quite common for these areas to be challenged, and Wyckoff calls them springs and upthrusts. Springs and upthrusts are a common pattern, but traders always seem to be taken out because of them. As a trader, I like to find ways to stay in a trade. Many times, instead of an order to take profit, I'll set an alert in the zone and then see what price is doing. If strength is present, the conditions are ripe to let the profits extend. If weakness is showing, it means to either scale out or lock in less risk or more profit. As opposed to using an indicator for a losing trade, I'll look at an indicator to see if there are other reasons to exit. The difference is, I look for it to tell me to get out as opposed to staying in. Think of the trades that are strong in your favor as a talent. Let it flourish and reap the rewards. Think of your profitable trades as being a product of your trading talent. Don't waste them. Expect the worst, but always ride the best.